I'm Michael Fox, and this is the Prospector News Podcast. And as we usually do after the Fed meeting, we have Chris Temple from the National Investor join me. Welcome, Chris.
Morning, Mike.
Yeah, well, it is a good morning. It's a bit of a bizarre morning. I have to say I'm baffled and confused with what went down on Wednesday. I see this in a kind of a strange light. Maybe it's, the season talking to me, but I see Jerome Powell as Alistair Sim in the Christmas Carol. He was pre Christmas Ghost Scrooge up until Wednesday. Then, we had an epiphany, and now he's I saw the ghosts and the light Scrooge afterwards. And I have this bizarre image of him prancing around his bed chambers like Alistair Sim singing, I don't know anything, I never did know anything, but now I know that I don't know. And we're off. Over to you.
You know what? You told me that earlier, and now we're talking about it again. I'm gonna have to get a hold of my cartoonist when we get off of here and have him draw exactly that cartoon of Powell prancing around like that. Look, there's no question that something changed pretty dramatically in Jerome Powell's own mind in the last month, because it was only a month ago when he was talking about still, and this was keeping on the same message that they'd had for a year and a half, give or take, that they aren't convinced inflation is back in the toothpaste tube yet. They believe that it's still going to require an extended period of below trend growth and some joblessness going up, et cetera, et cetera. And he had a very different tune, as you said on Wednesday afternoon. What struck me is that you've still got, at least as far as the official numbers are concerned, a very rapidly growing economy through Q3. But he wanted to stress that it slowed down in Q4. All right, well, we all know that it's inevitably going to slow down, but I thought that's what you wanted. I thought you want to sit and watch that for a while and make sure that slowing economy takes some of the remaining starch out of inflation, if that's even possible. So yeah, there's something that we don't know the answer yet. Frankly, to me, Mike, this reminds me of a now long forgotten episode from Jerome Powell after another Fed meeting in September of 2019, where out of nowhere he introduced briefly into the Fed lexicon the term plumbing problem. And you had back then a somewhat different set of circumstances. Certainly didn't have the inflation right now, but there were some stresses in the banking system. And that this was before COVID, and gave him the excuse to really open the floodgates and flood the world with money in an unprecedented way. But even several months prior to that, in the fall of 2019, he saw this plumbing problem. Now, he didn't say anything about that the other day, but I find it interesting that for all the talk of still lots of liquidity in the market, lots of cash on the sidelines, and so forth, that bank term lending facility that was introduced early this year has right now has got its highest outstanding balances ever. But we haven't heard anything yet in the news about other banks being in trouble. So, it makes you wonder if there's something going on under the surface of things, where finally there's some sufficient stress in the commercial paper, in the overnight lending markets, in whatever, that he's not telling us about yet, but gave him a reason to turn the animal spirits loose, maybe prematurely, on Wall Street again. Time will tell.
Yeah, definitely. And you kind of touched on, like, I'm looking back at the year, and the thing that has surprised me the most about 2023 has really been the resilience of the American economy. Jobs numbers remain, unemployment remains at historic lows. They're still creating jobs. The economy itself has continued to grow in spite of the rapid interest rate hikes. That had to be, the biggest surprise. Now, I recognize the lagging effects. I'm starting to wonder if the unemployment numbers are actually an indicator of a demographic problem. We do have an aging population that is, moving out of the job force and less numbers going in. That could be maybe a factor there. But as I look at all of this, I don't really see anything that's changed that would indicate that our inflationary worries are over.
Well, we have seen over the last several months, even though headline inflation has ticked down a bit more, largely because of the lower energy prices, which I don't believe are going to last for a host of reasons. The core rate has still stayed up. It's stayed stuck at around 4%. If you look at the services number, it's higher than that. So there's a lot of reasons why, and I've insisted this all along, that barring a major blowout in the markets, which causes a sharp recession in the economy, there's no way in hell that they're going to get inflation back down to 2%. There are way too many things baked into the cake over the last few years that are going to keep us at a much higher threshold level than we got used to for a very long time. So the Fed is betting, maybe the markets are most definitely betting that this pause in inflation's decline in the last few months, especially core measures, is going to take care of itself. And just by sheer hopium, we'll be at 2% in the next year, 18 months, whatever. And I just don't see that. So at some point, and they've put it off for a while. I mean, this whole move toward what I've continued to call the great stagflation. Yeah, we've still got high inflation, not as high as it was a year ago, but higher than it's been average in the last 40 years. We've got an economy that is starting to weaken, though not disastrously so. And I think all of those factors are going to be accentuated as we get into 2024. And God only knows what the year is going to bring us with the political circus we're going to have here next year in 2024. So I think that, as always, though, the old adage that the market can stay irrational longer than shorts can stay solvent. I mean, it's been a fool's errand, as I even told my readers again this week, closing out our last couple of short, hedges in our portfolio, that it's a fool's errand to try and fight this, at least right now.
Yeah, well, when the market's made up its mind, like tax loss selling rather ended rather abruptly on Wednesday. That's for sure. You can see the point exactly where he starts to make his announcement, and it was just like someone fired off the rocket and off everything went.
Yeah.
There was a lot to unpack there. Yeah, I agree with you what you're saying with energy prices. OPEC plus Russia have, ventured into, to cutbacks. We just came out of COP28 where they want to curtail more of the fossil fuel industry. All this is going to lead to energy shortages, and energy shortages are going to lead to higher energy prices, and higher energy prices are inflationary to an economy because they're literally in everything.
Well, exactly, and I think that's one of the most glaring areas in which the markets right now are really not comprehending this new world that we're in. One of the things I'm working on over the holidays, I got several special issues coming out on different themes. We're going to highlight some of the companies that I am recommending currently to my members. But the title of one of them it's kind of a takeoff of an old Hollywood comedy from many decades ago, but it's entitled "A Funny Thing Happened on the Way to the Energy Transition." And I'm not saying for a minute that the electric vehicle movement and the growing industry and whatnot is a hoax, or it's not real. It's certainly real. We're going to have more and more electric vehicles in the years to come. But policymakers who have no understanding or experience, or both, in the real world economy, in economics, engineering, extraction, all of these things, have set us up for a terrible rolling energy crisis for many years to come. We saw the beginning of it a summer ago when we saw gasoline spike to a record. We saw natural gas largely due to the proxy war that the U.S. started with Russia. We saw that spike. And those things for the moment at least have settled down. But what's the encore? I mean, you've got some of these people that think that that doesn't matter and that they can try and pile on as best as they can on the old energy fossil fuels as they just did over in the Middle East again. Not as badly, I think, as some of the reports are, but still, you look at the U.S. and Vice President Kamala Harris promised that there's going to be more done to curtail methane emissions because that's a bad thing. I agree, it's a bad thing, but the only thing that means in a practical sense right now is you're going to try and further curtail oil and gas production. Well, what does that mean? That means the price goes up, all else being equal. So you've got the inmates running the asylum that just throw out these platitudes and wish lists and utopian ideas without any idea practically how to get there. So we're going to have these rolling crises, shortages of various things and so forth. And I think especially when it comes to fossil fuels, we're not going to have the uptakes that have been promised in recent years of EVs and other technologies to get us away from fossil fuels in a meaningful way. It's going to be a long time before you have a major dent in demand for oil, for example. So, it's this is the price we pay for poor, if not criminal leadership on these things. We've got it here in the US, you've got it in Canada, other countries have it. Germany is this is part of their own suicide mission. Germany is getting all of these things wrong. And it's gonna lead to lower living standards. It's gonna entrench the great stagflation going forward. And I see nothing in front of us right now positive, with the exception of the nascent rebound of nuclear energy. Aside from that, that you can't really find anything positive in the overall energy game plan from the government.
No, I wouldn't disagree with any of those statements. I would, however, point out in Canada, the government is now looking into taxing, and I kid you not, they're looking into taxing cow burps in order to curb the methane in the atmosphere. No, I cannot make this up. That is on the agenda as part
Yep.
of their commitment to that. So, but I was over in London at a conference the last week in November, and in conversation with the numerous taxi drivers that I had, I found out that they are looking to put on a very large tax on people driving diesel cars inside the city of London. And, we're talking somewhere in the neighborhood, if you're seen driving around, and in London, it's one of the most surveilled cities in the world. There's closed circuit TV everywhere. If you're seen
Right.
driving around in a diesel car, you're going to be charged a tax of, I believe he told me, £65 a day. Um,
Wow.
that's going to, definitely have some significant impacts on that society. But again, it's, that's a tax that ultimately is going to be inflationary to their economy because, people have to pay the tax, so they're going to have to curtail something else. And I'm almost seeing a two-pronged inflation happening where the things that we need are going to go up very dramatically, very rapidly in price: food, shelter, energy, and the things that, are just wants, like maybe new cars, clothes, concerts out, dinners out, those types of things. They're going to suffer, and you'll see a deflation in those items.
Oh, I completely agree. And the unfortunate thing is that the stuff that people can't do without is what's going to be going up in price. The stuff that we can do without, I agree, it's going to go down. I mean, um, my wife and I are looking at a possibility of getting a couple of newer pieces of furniture for a couple of different reasons. And I'm never been one that likes to spend money on stuff like that. I always go to the secondhand stores or find something on marketplace on Facebook or something like that. I hate spending money, period, on things that aren't necessary, and especially with a dog in the house that loves to chew on things. But one of the things I said to her is that, let's keep an eye on, Costco and this and that. After Christmas time, they're going to be marking down a lot of stuff that they're not selling because, as you and I discussed when we were in New Orleans, there's already and I don't know what the number is, the bottom 50 or 60% of the income scale in the US, they're already feeling a recession. They're already pulling in their horns. I could spend all day just with anecdotes from people I know who own businesses, whether it's a restaurant, whether it's a clothing store, whether it's a fishing guide or whoever. And they're seeing people start to slow down some of this spending now. And this has been going on for a while. So that is going to lead, yeah, it's going to lead to a lot of stuff being cheap. I remember years and years ago, there was a guy, I don't know if you remember this name, Mike, but a guy named Al Bryan had, I think it was called the Hard Money Analyst newsletter. And I mean, I got his newsletters going back 30 and 40 years. And one of the headlines I remember vividly because it's appropriate at a time like this, the title of the cover story was called Toys on the Lawn. And he made the case about how when things start to really get tight and people are squeezed so much by the inflation of food and gasoline and shelter and healthcare and all these things, that's all they got the ability to spend money on. And all of a sudden, all of the extra vehicles, the RVs, the boats, the ATVs, the UTVs, the whatever you call them these days, you're going to be going down the street and you're going to have these things all over the lawns, people trying to get rid of them. It'll be similar to the iconic photo after the stock market crash in 1929 of a guy out in front of the New York Stock Exchange with a rock bottom price on his new car because he needs cash. So yeah, I definitely think we're going to that kind of world. I think car prices have probably peaked. A lot of people argue about that because there was such a slowdown in production. But I think that you're going to start to see these things piling up, and you will get a lot of price cuts in these, durable goods and these wants, as you pointed out. But unfortunately, that's not what most people are going to be affected by because you don't need to get all these things all the time. Food's going to continue to go up, energy is going to continue to go up, et cetera.
Yeah, not to mention housing,
Right.
that's gonna put more pressures on the homeless crisis in both of our countries as well. So
Sure.
the other challenge that I see the Fed having with inflation over the past several months, there's been an awful lot of strikes, and the unions have gotten, and rightfully so in a lot of cases, they're playing a little bit of catch up, but they've gotten an awful lot of concessions with higher wages, higher benefits from employers, and those added costs haven't been factored into the supply chain yet either. So that's also going to have
No.
inflationary pressures.
Well, you're absolutely right. And going back to last Friday, we're recording this, of course, on Friday the 15th, but last Friday, when the numbers came out for the employment statistics for last month, the unemployment rate ticked down 0.2%, number one. And number two, wage gains continued to stay at 4% plus year over year. And that's everybody that they measure. A lot of these big unions for UPS and FedEx in recent times, for the automakers, their wage gains were a hell of a lot more than that they got as far as concessions from the companies. So you're absolutely right that this wage price spiral, maybe it's not as dramatic as it was in the 70s, but it's there and it's not going away. It's going to become entrenched. And so here again, for Powell to change his rhetorical tune as abruptly as he did from a meeting, 3 weeks or whatever it was, 4 weeks prior to this last Wednesday afternoon, you have to wonder, okay, what does he know that we don't that's got him a little bit more nervous? So he needs a little bit more juice and animal spirits in the market to cover. We may find out at some point down the road, but you're right, absolutely right on the wage thing.
Yeah, well, given that we see increased inflation coming down the pipe, and they keep claiming to be data dependent. We've had people up until this point who believe now, they feel exonerated that this is the moment of the Fed pivot. But is this a false pivot and the Fed's going to pivot back to their hawkish stance sometime next year?
Well, that is very possible. And in fact, against, Powell's, enlightened Scrooge behavior, and the Alistair Sim one was my favorite of all of them. I don't know about you. That was always my favorite of all of the old ones. Not that George C. Scott did do a great job. He did too, and the rest of them, but I loved Alistair Sim. But despite that and Powell's good cop behavior on Wednesday, John Williams came out this morning and did the bad cop. So you had a brief give back of the stock index futures, which had been a fair bit higher. They gave back the gains, before the market opened. Interest rates popped back up several basis points. And Williams, even though he's not the vice chair, he really is at least the second most important guy at the Fed, because being the president of the New York Fed, he's the guy that runs the checkbook. So he sees these things on the ground every day that some of these other people who are more policy wonks and taking a high level view don't see. And Williams came out and pushed back against the expectations that Powell engendered and some of the market reaction since then. And he said that very thing, Mike, that we need to still follow inflation. It is not guaranteed that we're done hiking rates. If we see the data go the wrong direction in that score, the possibility still exists that they would reverse course from this pause. So I think at the very least, and again, why Powell changed his tone, I don't understand, because he really didn't do himself any favors. But I think at the very least, markets are way ahead of themselves, thinking, as they apparently do now, that there's going to be a rate reduction as early as March. If we don't see a continued significant decline or renewed decline in inflation, especially those core measures, I just don't see him doing it, barring a financial problem of some greater magnitude than anything we've seen out there right now. So yeah, it is possible that the markets are wrong, not for the first time during this whole process. But the thing that we need to keep in the back of our mind, and folks, if you've not read this yet, go to Mike's website. You'll have to tell him how to get it specifically. Look at the latest Prospector news, where once again I was privileged to have the cover story, and my commentary on supply is very appropriate, because when you look at all of this money that the Fed first came out with prior to finally starting to raise interest rates going on 2 years ago, they so front loaded the liquidity equation. I mean, we've used this term before, but 30% of all of the US dollars ever created in the history of the US of A were created in under 2 years by Jerome Powell and his crew. And if you look at the long-term chart of M2, the broad money supply, even after it has come down a fair bit in the last 15 months, give or take, it's still well above the trend line that existed before it went parabolic for a while with all of this money printing. So there's still a lot of liquidity. The M2 is certainly not hurting yet. I've heard numbers bandied about that the Fed can take its balance sheet to 7 trillion or less before, instead of rug burns, you start to draw blood in the market. So there's still a lot of this ringing out to do. And here's the really cool question going forward, and this will get the gold bugs animated out there in our audience. I've believed all along that even though the Fed went farther and got away with it so far, more than anybody thought they would, as far as raising interest rates and so forth, because they had room to do it because of all that prior liquidity. When does the point come? And this is one of the things I think that some markets, maybe not incorrectly, were starting to sniff out on Wednesday. When does the point come that the Fed pauses or signals that may reverse course well before inflation is down? Because I think that's where we're going to end up. I think that we'll get to maybe the middle of next year or so, Mike, and core inflation and certainly headline will have ticked back up somewhat. And the Fed's really going to be screwed because by that time, the economy is slowing down more. It's like, oh my God, if we don't raise rates again to respond to inflation, now the markets know that we're bluffing and there's no way we can get inflation down to 2% because they can't, barring a depression, nearly, because of all these things that have been baked in, all of the monetary inflation and whatnot. And what they're trying to postpone for as long as they can. And Powell gave you just a little bit of this the other day and then didn't really want to admit it. And then Williams walked it back today. But the end game, I really believe for them, is that they're going to stop reducing their balance sheet and maybe even have to start cutting rates as inflation is rising again. And that's when the light bulb really goes off over everybody's heads and says, oh my God, it really is the great stagflation. I want gold, I want copper, I want energy, etc.
Yeah. Well, that leads us to the next question. But before we ask that question, I will put the link to that article Chris referenced to the bottom of the description of this particular podcast. Well, there's two questions actually. The first question relates to that Fed pivot. As they were raising rates and inflation was not going down. You recall, I thought that the Fed pivot would be exactly that. They would pivot to a higher target rate for inflation. So you're telling me you see that actually coming at some point in next year. The other thing that I openly wondered in probably a couple of podcasts ago, um, next year is an election year in the United States. Is the Fed really wanting to be an aggressive player during an election year? I know they're supposed to be, nonpartisan, but it is an election year. Everyone becomes partisan.
Well, look, Mike, a lot of people have this belief that the Fed tries to be helpful, during an election year. That's not always the case. You can go back to Jimmy Carter when he ran for re-election. You can go back to George Bush Sr. You can go back to Bill Clinton, who even though he got reelected in 96, lost dramatically in the House and Senate both, partly at least because the economy was weakening because of Fed tightening, and on down the line. So it's not a given. Now, granted, a lot of people in Washington, one way or another, are on the single-minded quest to make sure that the Orange Wonder doesn't get back in the White House next year. And so, maybe there might be some unspoken desire to help the economy and the markets both to make things less bad than they might be for Biden if he's the nominee or whoever might still replace him. So who knows? But I think more so this is a matter of the Fed, as always, and we always have to keep in the back of our mind, and I've explained this many times over the years, when you have a fractional reserve banking system as we do, as time goes on, it just gets harder and harder and harder for people to even service debts, let alone pay them off. On a debt score, the Fed has been the chief enabler of the explosion in the U.S. national debt. We're 34 trillion or whatever it is these days and counting, $2+ trillion deficits and more as far as the eye can see going forward. Interest costs recently crossed $1 trillion a year. There'll be $1.5 trillion by the end of next year, as a lot of debt comes due at higher rates in 2024. So everywhere you look, I mean, the Fed is having to figure out, okay, we need to keep inflation in check, but at the same time, the only way that we service these gargantuan debts is through inflation. We just have to call it something else. We just have to come up with more mumbo jumbo and more cooked numbers at the BLS, which stands for the Bureau of Lying Statistics, to act like inflation isn't as bad, even though Joe Sixpack and Sally Soccer Mom all know it's a lie because they have to pay for their housing and healthcare and energy and groceries.
Yeah, they're going to be faced with, I think they're heading on a collision course to a real problem next year. Be it energy, be it inflation, be it promises that, they're not going to be able to keep. The question that comes out of all that is, we've seen a couple of real monster moves in precious metals. We had one a couple of weeks ago that fizzled out and spiked back down as rapidly as it went up. And we seem to be, after Wednesday, we seem to be on another run towards that upward limit again, which would be the fourth top, so to speak. What do you see all of this actually mean for the gold and the silver markets?
Well, look, let me talk with gold primarily. Silver, is kind of a hybrid discussion because you've got economic impacts to silver, good or bad, that you don't have as much with gold. Gold is more of a hedge against uncertainty, and it's a monetary asset, et cetera. I've said for a while that gold, although the downside risk has really been minimized by everything that we've seen in the recent past, at the same time, there's not the coalescence of ingredients I still think are necessary for a sustainable move to new all-time highs. And I'm going to again make the comparison to today's time and with the time back in the immediate wake of the financial crisis in 2008, where gold tripled in under 3 years. What happened back then was, number one, that you had a Fed that was expanding in a panic, the money supply, chopping interest rates to nothing, et cetera, number one. Number two, that did not help for quite a while the overall economy, which was so badly hit by the collapse in mortgages and real estate and et cetera, that all of this money the Fed was printing just wasn't going to have any traction for a while in resurrecting the stock market, derivatives markets, real estate, or anything. So back then, generalist investors, who were the ones that caused this move, gold didn't triple from, the end of 2008 to the fall of 2011 because all the followers of, our friends Brian London or Peter Schiff or whoever were buying gold. They're always 100% invested. They don't matter in the market. I hate to tell you, folks, it's not don't take personal offense, but it's because a lot of other people saw this set of ingredients and said, okay, maybe the guy's calling for a big move in gold are right, because the Fed is printing all kinds of money and it's not having traction anyplace else. By process of elimination, it's going to go into gold. And that's why we had that move. And when gold peaked in 2011, gold and silver stocks peaked well before the metals did. Why was that? Had the Fed stopped printing money? Had the Fed started raising interest rates? No, it was because finally all of that monetary inflation had some traction in bringing real estate off of the map, bringing the stock market back up, and so forth. The problem today for people that think that we're starting another secular move higher in gold, which I believe is coming. I'm not saying that at all. But look at this last week. Yeah, gold had a nice rebound after the Fed meeting, but so did a whole lot of other stuff. And we're at a place still where enough other things work for generalist investors, whether it's buying even more of NVIDIA, no matter what the nosebleed valuation, buying more passive ETFs, buying more of the Magnificent Seven, buying small caps. Not a bad idea, because they've still got a lot of catching up to do, whatever. And for gold to make a sustained move and go on to yet new all-time highs and keep going, those other things are going to have to start to bog down. And we're going to have to see the Fed not just have this whatever kind of dopey pause with a hint, wink, nod, and shoulder shrug, and signals like a third base coach in baseball to the markets that, okay, maybe we'll start lowering interest rates at some point. They got to do it as the economy slows down. And when that happens, that's when gold's going to take off. We're some months away from that yet, but it's not too early, especially with so many things cheap right now, because of the disaster that the market has been for a lot of junior resource stocks, not just gold, of all kinds. There's a lot of things you should be buying right now, even if you're going to have to wait several months for the big launch.
Yeah, well, when you're dealing with outsized returns, time, if you have time as an ally on your side, uh, you have that opportunity. If time's not an ally, then yeah, that 3 months is like an eternity.
And let's not forget, I need to point this out too, that I've said this before, the market has changed so much as far as the players that are, at issue potentially to drive gold or gold stocks. I don't think you're going to see for quite some time to come this rising tide lifts all boats. I mean, let's go back again in time. It took a long time for gold to get to $1,000 an ounce, which it did in 2007. It bounced around a while, then it dropped to under 700 an ounce at the bottom of the market when everything went down initially in the wake of the financial crisis. Gold was $670 or something like that was the final bottom. Gold tripled to yet unprecedented highs at that time. It peaked at a little over $1,900 in the fall of late summer, early fall. I forget when it was of 2011. And that kind of a massive move did pretty much levitate all of the gold equities, good, bad, ugly, big ones, little ones. There's very few left out. To this day, with gold roughly at the same place in nominal terms, most of these stocks are still down by half to 80 or 90%. And there's a lot of reasons for that. And you're not going to change that by gold, going to 2,100 or 2,200. You're going to have to do a whole lot more than that. And I do believe a move like that is coming. But again, I think that one of the key ingredients that has to happen first is that, there needs to be much more serious question on the broad stock market with earnings slowing down next year, with the economy bogging down more and more broadly. And that's when the next launch will come. I'm quite sure it'll be in this next year. I don't, maybe not January, but we may not have to wait till December either.
No, we won't. I did a podcast yesterday with David Erfley, the junior miner junkie, and his position was that if gold has a monthly close above the 2,100 point, because that would be a new high essentially. That's the point of takeoff, was his position, but he's strictly a chartist as well.
Well, that might be the point of takeoff if you're talking about the big ETFs, GDX or GDXJ. If you're talking about the Newmonts and Barricks and Agnicos and so forth, that move early on isn't going to do a whole lot more broadly to help a lot of the juniors. It's going to have to be bigger than that, in my opinion.
Yeah, I would agree. The first movers have to move first. That's why they're called
Right.
first movers.
That's why they're called first movers.
So if people want to follow your musings as we go forward, how would they do so, Chris?
Best is to go to nationalinvestor.com. If you're not already on my email list, make sure you sign up for my free email list. You get a lot of different special issues, commentaries, and whatnot. If you want all of my specific recommendations, there's a link to subscribe. And as far as social media, I do the most and spend the most time on Twitter/X. And my handle there is @, of course, Nat Investor.
Wonderful. Best of the holiday season to you and your very large extended family. And I look forward to having you back on in the new year.
That's awesome. I'll look forward to that, and the best of everything to you as well, Mike.
Thank you, Chris. The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.